Good morning, everyone, and good evening and good afternoon, depending on where you are on our globe. This part of the globe where I am, around New York City, is extremely cold this morning. I also heard on the radio on the way in that it is 39 degrees Fahrenheit in Hong Kong. If anyone is in Hong Kong, perhaps they can verify that. That's an astonishing bit of chill for that part of the world. It's also very warm in Russia, where the Olympics are, down in the southern part of Russia. So, it seems appropriate that we spend a lot of time this morning in this session looking at currencies outside of the ones we're used to. Now, there's been a great deal of coverage of this, of course, lately, so it's an interesting and it's a topical topic. That's wonderful, isn't it? A topical topic. Just a few notes here. If anyone has any questions, comments, considerations, or anything, or I get anything wrong while I'm talking, which is always possible, and perhaps more than likely, please be glad. I'll be happy to stop and comment on whatever you have to say. Just type it into the chat, and we'll talk about it. Once again, of course, I'd like to thank FX Street for their facilities for putting on these webinars. I find them very entertaining, and hopefully everyone else does too. So, we have on the screen the Brazilian real. Now, as a trader, this would seem to be a whole lot of fun. You have a powerful up move. You have, not only is it a power, this is true of all of the emerging markets. Let me backtrack a little, make some general comments. The emerging markets are the farther shores of currency trading. There's a good deal more volatility. You will find less access to the markets. I mean, not every retail system offers many of these currencies. We ourselves do not. Yet there's also tremendous possibility there. You look at a chart like this in the Brazilian real, fear and greed. Not only that, look at this particular chart from May until now. It's a very powerful trend. It's a powerful trend with some powerful profit taking as well. But it is nevertheless a powerful trend. If you compare that with the current euro chart, which I won't do because I'm sure you're all familiar with, you can see the difference. The euro has been diddling back and forth without really making any pronounced move in any direction. So the emerging markets are attractive places to trade. They are also much more dangerous places to trade because of the size of the moves when you're trading on margin. But again, putting the emerging markets in the context of the world that we're dealing with, this is the Russian ruble, not as strong a move, stronger move here, but nevertheless a beginning to move back in. Before May, we hadn't gone above 32. Since May, we haven't really been below 32. Let's take a look at another one. Oh dear, here we have the same thing. Before May, even be charitable. Never went above 1.9. Since May, since the beginning of June, or the middle of June, never went below 1.9. Now we could go through any of these. I will, let's see, we have here. This is one we're not actually looking at, but I wanted to put it up. The Indonesian rupiah. June, volatility, and you can see the results. We can look at some of the, I'll look at that in a minute. And this is the Indian rupee. Again, clear as day. So we have a reference point sometime in May. Yes, I just put that up. Okay, so where is my 10-year chart here? I think that one didn't come through. Okay, luckily I have this one right here. Okay, now, I actually put up or sent over a chart Oh, I know where it is. It's right here. I'm sorry. Here it is. Technology has never been my forte, as you know. Words. Okay, this is the 10-year U.S. And what do we see? Of course, we see exactly the same reference points. Now, these lines are sort of market projections. What I mean is, if you were trading the 10-year in this period here, this is the trend line you were looking at. If you were trading it after that break, this is the trend line you were looking at. And then there's always this trend line down here, which really doesn't mean that very much. But I'm just trying to put it into context of what the market is thinking at the time. So when we look for a reference to the currencies we just looked at, we have the long-term reference right here. That long-term reference is the world's central bank running out of D.C., the U.S. Federal Reserve. I know there are other important central banks in the world. This smacks of American chauvinism, but in fact it's not. Because you are looking at far-flung references. I mean, let's just take one, any one we like. Let's look at my favorite. This is not a very useful one, actually. This is the Argentinian peso. And this, as you can see, is a product of probably some of the worst governance by a semi-developed country, or at least it's semi-developed now, in the West. Okay, so let's just take a look at almost anything else. So again, this is the point. There is a specific reference to the U.S. Federal Reserve. That tells us something else as well. Much of the events that have taken place, developing countries, more than anything else, need capital. They need investment. They cannot generate enough internal investment to propel their economies to levels that they would prefer. So they have a powerful incentive for overseas investment, to try and attract overseas investment. Overseas investors, especially in an era, as we are in now, of financial repression. Now, what is financial repression? Financial repression is artificially low interest rates. That means interest rates that would not be at this level without the direct intervention of a government entity. I heard an interesting comment from the Credit Suisse economist, whose name escapes me at the moment, on the way in this morning driving in. People have taken, myself, others included, many of them, to talking about this particular interest rate regimen, where we are now, for the past 5 years really, but especially more lately, where the Fed has been intervening directly in the markets to keep U.S. interest rates down as financial repression, meaning they are repressing the return of financial instruments. For those of us at the retirement age, I am not including myself, not just yet, this is a problem. Risk appetite in individuals and in portfolios declines as people age. It is the young and the younger who take chances. So financial repression tends to diminish the amount of capital available within the country. Because when the capital looks for better returns, it's forced in many cases to the equities, but especially to foreign equities. Now, we're not talking about, someone whose 401k of $300,000 is suddenly flung overseas to be invested in the Argentinian peso. But we are talking about proprietors of the money that is available to seek returns. And that is the money that created this. and it's also the money that draws it back. The point to the comparison is that with almost everything else in the financial world, and probably a general statement in life, it's a two-edged sword. Emerging economies need, desire, and want to attract capital. Let's take a look at the equities. That was just, what did I have up there? That was the Brazilian real. Okay, so let's take a look at the Bovesa. Okay? The ability and the interest in attracting capital. So how did the Bovesa back here and here get to these astonishingly high levels? Let's see if we can find another even more graphic example of it. This is Argentina. Okay, this is Argentina, which is not a particularly good example, but it looks better graphically, but so I'll use it. What is the Argentina Merval doing at these levels? Or let's take a look at another one here. The Sensex. Okay, that's the Indian. The Indian equities. The countries that need and want to attract investment. What's the purpose of the stock market? The purpose of the stock market is direct investment throughout the economy in the most efficient fashion. So the money that flows in from overseas ends up, in many cases, in the stock market. And there's a reason for this. There are two types of investment that you can do. Well, there are actually many, but just two main ones that you can do in a country's economy. You can do direct investment, FDI, foreign direct investment. And that is buying part or whole of a factory, of a business, actually buying an individual company. If you are a big American corporation, perhaps buying and you make pipe, perhaps buying a Chinese pipe maker, or buying a Turkish conduit maker. That's direct investment. It's long-term. It's very difficult to pull the money out on a basis, on a piece of news. If you've bought a factory, you can't turn around and sell it in 10 minutes because you heard that the Fed is going to start raising rates. You are in for the long term. By and large, governments like FDI. Creates jobs, and it is a long-term commitment. It is, of course, subject to currency risk, but any investment in an overseas country, a different currency than yourselves, is subject to currency. It was funny, we were cleaning up we're probably going to move, my family, and we were cleaning up the library, and I have a whole collection of money from overseas, of all these various places that I've been the past couple of years that I bring home. So the kids found it. My two girls are 5 and a half, and they were trying to figure out what this stuff was. And the only one that they could identify was the Chinese yuan, because they can recognize Chinese writing. They can't read it, but they can certainly recognize it. So even my 5-year-olds are now aware of the closeness of the rest of the world's economy. I think they're going to take them to their show and tell, which is now called sharing. The language changes, the terms change, not always for an improvement. But anyway, so the degree, which with the American economy, which was long one of the most insulated. Now, we live in New York, of course, which is probably one of the most cosmopolitan places in the United States. But the degree to which the American economy was insulated from the world has gone down tremendously. So, back to investment between FDI and stock markets. So countries like FDI, there's more control over it, and it's long-term. But Countries also recognize that FDI is difficult to do. It has a much longer lead time. And many countries or many businesses are wary of FDI. Because once the money is in, it's very hard to get it out. The alternative, of course, is investing in the country's stock market. And that is what we have seen in many of these countries. This is the origin. This is why I started with this chart right here. The U.S. 10-year rate, which is indicative of what is going on in the U.S. economy, or at least in the U.S. financial sector. The turmoil in the emerging markets currencies has been eminently predictable. And for traders, that's all of us, that is probably the point I'm going to stress the most. The volatility, let's take a look again. Brazilian real. The volatility is dramatic. It makes it difficult from a trading point of view to hold on through the swings. But the long-term trend is something that all of us can understand the point. This is very, very much a macro event. It's a macro event based on a specific change in policy from a specific central bank, be it Ben Bernanke's Fed. By the way, Janet Yellen is going to do her first public testimony, I think tomorrow and then Thursday. I think it's congressional testimony. I think it's probably the House of Senate. It might be that Humphrey Walker full employment testimony. It'll be interesting to listen to it. I think I'm actually going to listen to it live, which I've never really done before, even when Mr. Bernanke was doing it. I feel obliged to do that because Ms. Yellen is from Brooklyn, where my parents are from, a neighborhood which is actually very well known to me, Bay Ridge. So I feel that I should be paying attention to what Ms. Yellen has to say. But on top of that, of course, it'll be very interesting to see what she stresses. And the markets are going to pay an inordinate amount of attention to this. Back to this chart right here. This, as I said, is a macro event. It's an event which can be traded. You have a trend here from May until February. 1, 2, 3, 4, 5, 6, 7, 8, 9, 10 months with a big profit-taking change in the middle. This is September 18th, of course, when the Fed decided not to taper. So all of the events that we're looking at here in emerging markets relate back to a specific event in the developed world. Now, let's take a look at some of the differences, though. All emerging markets are not the same. First, let me bring up one chart here. Where is my Euro chart? Excuse me. Sorry. Okay, now, compare the two charts. This is a 2-year chart. The other chart went back to about here. The volatility, the trading potential on the other side is far greater. That is why it attracted the money in the first place. If you are I know they get a bad name anytime. It's like talking about, a wicked witch as a motivation, as a story event in kids. Yes, I know. The kids keep creeping into my discussions more than they used to. Yeah, I know about that. Sorry, I'll try and fix that. But as an event, as a motivation, or as a cause for a particular event, the hedge funds get all sorts of credit where credit is probably a lot less due. But in this case, there is some truth to it. What you're looking at when you see an event like this, and let's just take one we haven't looked at yet, the Russian. Okay? When you see a stock market with this kind of gyrations, especially this one right here. Come on, Mark, come on. Sorry, this thing's a little bit whiffy. These right here, right? Come on. You're looking at the impact of overseas investment money, which is perennially called hot money. What does hot money mean? Journalists like to have lively copy. I was watching an old BBC series last night called The Duchess of Duke Street from the 70s with Gemma Jones. It's very good, but one of the episodes, a number of people invested in supposedly a surefire, would have been FDI, foreign direct investment, on diamonds in South Africa, based on a report of how plentiful they were in this particular location, which turned out to be a falsified report. They lost all their money. But what is that except another instance of hot money? The search for yield, or the search or impelled by greed, if you will. And what was the discussion before this particular investment in about 1910? It was the inability to get decent returns in bonds or gilts, which were British, and this took place in Britain, of course, which were gilts, which still are the British equivalent of treasuries. I don't know if I'd call it financial repression, but again, exactly the same motivation. Driving people overseas 100 years ago, and you could go back much further than that, same thing here, hot money. The type of money that supposedly can be flicked overseas with the index finger on a keyboard was exactly the same kind of money that could have been flicked overseas by the index finger on a telegraph in 1910. So the types of changes that we're seeing now are different in volume, but not in motivation, not in direction, and not in complexion. They're all the same. So the types of gyrations that you're seeing in overseas markets and overseas currencies were not invented by the internet. They are a historical fact, certainly relating back to instantaneous communication and the telegraph. And before that, the investment was still possible, but it was a lot harder to get it out simply because it took 6 months to get someplace. So this type of investment, the hot money supposedly, meaning the money that's searching for yield, is both a danger and a benefit to overseas economies. It's a benefit because they seek it and because it is a benefit to their economy, at least they hope so, because it will invest. But it's a danger because investors, be they currency traders less so, but certainly equity investors, have a tendency to view equity levels as a given, and any retreat from those levels as a loss. Now, professionals should not view it that way, and we should all consider ourselves professionals or semi-professional. But any stock market, like Brazil, back here, or even here, driven to, and this drop right here, is the Fed drop. This rise here is the Fed rise. Although a little bit less, but yes. Because right here we have May to what looks like early July. And then we have it rising back to November and then down. This coincides roughly with the Fed pronouncements and then the actual enactment of tapering in December. Not quite, but a little bit, but pretty well. There are two things that are true about markets. Equities, currencies, whatever. Any interest in a market, regardless of the macro factors, will drive the market in a particular direction. So that anyone who's thinking, when the Fed starts QE, at whatever QE you'd like, and people start thinking about where am I going to find return? This isn't, my point of the 100-year story is this is an old story. Market historians, to some degree, we're all market historians. It's our purpose. It's our intent. It's how we do our business. We look at historical factors. We look, what is a chart except a historical record? And what are we, when we study it, except historians? So everyone involved in the market, certainly in the equities, international equities, knows, or they should, if they're any kind of historian, and just pull up a chart and send it back 100 years or 50 years, that one place always to look for return in international economics or overseas developing markets. In the 19th century, what was the big developing market? It's a rhetorical question, I'll answer. It was the United States. It doesn't seem like it now, but it was absolutely true. The United States was where European capital invested. And what was the big technology? Railroads. From about 1830 to probably 1860 or maybe more. Huge investments, largely of overseas capital in the United States in railroads. A lot of booms and busts, a lot of panics in American stock markets, all sorts of stuff. But as you can see from the history of the United States and the world, it was by and large successful investment. I'm, please, leaving the politics of this out. So that type of search for yield and places to invest, the greatest place to make money are in new burgeoning markets. Most of the people here were partners, including myself, in FX Solutions before worldwide markets. FX Solutions started in 2000, and we sold out in 2007 to an equity house, Francisco Partners. But the explosive growth in that company, in that market, was what people are looking for. They're looking for it when they invest in the Brazilian market. They looked for it when they're investing in railroads in the United States. They look for it now when they're buying Twitter. The greatest amount of money made in equities, made in businesses, are in new markets. It's why they're so attractive. It's why they're so dangerous. Because nobody knows how it's going to play out. If you buy gilts, or you buy treasuries, or you buy, like my father, United Technologies stock. I think I got a check yesterday for my father's 21 shares, which are not worth very much, but I keep them for sentimental reasons. So I think I get about $60 a year from these 21 shares in dividends. There's no explosive growth there. United Technologies business is tied very much to government defense contracts. But one type of investment wants that. So everyone in the markets, very locution I'm trying to lose, involved in equities or looking for returns, hedge funds, what I call hot money, looks immediately as they did overseas, knowing two things. Well, maybe more than two things. One is that you are likely to get better returns there. First of all, they're paying better returns on their bonds because it's riskier. Two, you're not the only one who's going to do this. Everybody else, or a good portion of everybody else, is going to do this as well. So if the guy who's running hedge fund number 3 and the guy who's running hedge fund number 8 and number 27 and number 32 and all the rest of them all start putting money into the Brazilian Bovesa, it's going to do two things. One, it's going to drive up the Bovesa, probably well beyond, if there's anyone out there who speaks Portuguese, forgive my pronunciation, it is undoubtedly inaccurate. But I am, as most Americans, quite monolingual, although I can fake Italian sometimes. Okay, so we just looked at the Bovesa and what the Bovesa did. Okay, we know this is going to happen. This is something, yes, China is much more difficult. I'll deal with it in a second, mainly because it's much, much, much bigger. But actually, the stock market in China is not that much bigger. But let me take all of those questions as a unit, so I can deal with them all at once in China. So, the search for yield, which is what we're talking about, and it is always, remember, a predictable item. Macro moves are utterly predictable. Let me change that. They're not predictable in the sense that you can't be sure when they're going to start. In other words, let me further qualify this. Sorry. A macro move such as a developing economy is predictable. Its variations, its gyrations, no. A macro move in the sense of a central bank rate cycle is predictable once it has taken place. Meaning, if the Fed announces they're going to, as Mr. Bernanke did in May, that they're thinking of tightening, this is a macro event. No one knew that Mr. Bernanke, at least I did. Maybe someone out there did. Maybe Francesc knew because he has very good connections. He's the founder and head of FX Street. But once Mr. Bernanke came out and said that the Fed is thinking of tapering, which means tightening, they both begin with T. I don't know if that's important. And they're both gerunds. Then the rest of it was predictable. It wasn't predictable exactly how it was going to play out, but the intent of the statement can only lead in one direction. And if you pull back, as good traders should now and then, and assess where this can possibly go, and don't assess it in terms of your position, assess it in terms of what you know. So if you're invested in the Brazilian Bovesa, and you hear Mr. Bernanke talking about the beginning of the taper, what should you do? Well, you should do this. And that's what the overseas investors in the Brazilian stock market, the ones that were there not for the long term, but for return, should do. Okay? So what are the two kinds of return? One, of course, is that the obvious one, that Brazilian Bovesa is going to go up if people buy into the stock market. Okay, so what else is going to happen? Well, this is going to happen also. Prior to this, in order to buy into the Brazilian Bovesa, well, what do? This seems very simple, but we must remember these things when we're trading because it's the simple things that run markets. There's no secret knowledge. There's no secret study. There's no secret indicator. There's no secret society. What drives markets are very accessible, analytical ideas. Accessible to all of us. This is the main reason I find markets interesting. It's because the ideas are basic, the ideas are accessible, but they also require a good deal of discipline to separate them out and to stay the course. So, the other thing that overseas investors, I'm trying not to blame the hedge funds for all this, know, when they start looking for yield? One, their interest and the interest of everyone else, meaning there are going to be a whole lot of other people doing it beside themselves, is going to drive the market in a particular direction. Two, they know it's also going to drive the currency. So if you have to invest, this is very obvious. You have to invest in Brazil, you need reals. My ATM does not dispense reals on the corner of 114th Street and Broadway. Actually, it's 113th Street. Dispenses dollars. Your ATMs, wherever they are, do not dispense reals unless you happen to be in Sao Paulo. By the way, I wonder, is anyone going to the World Cup this summer? Don't say anything. That's off the topic. So any investment, any search for investment overseas is also going to drive the currency. So from a investment point of view, from a hot money point of view, from a hedge fund point of view, again, I apologize to any hedge funds out there if they're listening. That's unlikely. I don't mean to categorize you as the source of trading motivation. It's not true. The problem with this, of course, is this is an eminently reversible and predictable event on both sides. It is not like a long-term investment in FDI, foreign direct investment. It's a trading investment. When people send money, when they know, when the Fed starts doing QE, and you have, and they've been doing it for 5 years now, but especially the last one, where they are specifically targeting market interest rates as they did, then you know that overseas is where the money is going to go. So if you, on that motivation, looking for return, invest in the Brazilian Bovespa or many other markets. I'm not just focusing on Brazil. But Brazil is probably the largest of these developing economies. I don't know exactly where it is on the scale. Certainly less than China, of course, which is the world's second largest economy, but it has far fewer people. You know that it's going to drive the market up, it's going to drive the currency up. You benefit in two ways. Market gets stronger, your investment's worth more, and the currency in which you're invested in is also stronger. It gets more dollars or euros back. But you also know that as soon as the policy changes, or there's any hint that it might change, everyone is going to run for the exits. It's basically going to be a fire in a theater. Everyone's going to try and get out the same door. The door is smaller because the markets are smaller. And then you have this right here. So again, this is not a trading event. This is not an investment event. It's a trading event. From our point of view as traders, this is something we can utilize. This here, if you're an equity trader, is eminently predictable. This here, if you're a currency trader, is eminently predictable. And that's something we'll have to all try and remember when that's the case. Because what is this the reverse of? It's the reverse of what we saw in the other chart. If you have many investments in the Brazilian stock market and you need to get them out, what do? You sell reals and you buy dollars. What is this? Selling reals and buying dollars. Okay, so can I ask never mind. I have a question which I'd like to send around, and we will put the polls up. I can ask questions, and then the FXG people will put them up. I'm just kind of curious as to we're considering here adding some EM currencies. I think it would add a great deal of interest. We're all going to start trading Bitcoin, but I'm going to do I think maybe I'll do a webinar on Bitcoin. It's a fascinating topic. The problem is the topic is mostly theoretical. On the way in, I heard this morning that on Mt. Gox, which is, I think, the biggest Bitcoin exchange, it runs out of Japan. there was a bad price on there this morning. So suddenly what looked to be about, I think it was trading about 600 or 700, suddenly a price ticked in at like 182, and so the market went crazy. Anyway. Okay, so we're considering that, and this is one of the things I'd like to know. I think would be very interesting. It's not that hard. It's pretty easy to get accurate pricing, and I think emerging markets would be a very interesting addition for our currencies. You know, the emerging markets reminds me very much of the types of trading that went on in Europe So nobody trades. I can see the results up there. So nobody trades. I mean, I think that's probably a function of how difficult it is actually to trade emerging markets on many of the systems. Certainly, if you're on our system, you can't do it because we don't offer it. So that's probably not. I probably should have asked how many of you would like to trade emerging markets. Okay, so the turmoil in emerging markets that we're seeing right now reminds me very much of the type of volatility that we used to see in the minor European currencies. Excuse me for all of the FX Street people there. I know that most of them are not old enough to remember actually trading in the European countries, European currencies before the euro. The people at FX Street are all largely euro children, basically. They've come of age into the adult working world since the euro started in 1999 and 2001. But before that, all the European countries, of course, had their own currencies. And there was phenomenal volatility in some of the smaller currencies. The Austrian shilling, the Belgian currency. They would go bananas, especially under because they had some of the same issues that the emerging markets currencies have now from a market point of view. They had to pay higher returns because the currencies saw volatility, and because the markets were smaller, they were subject to more volatility. So, not ever to call Austria or Belgium an emerging market, but from a market point of view and a trading point of view, there were quite a few similarities in those currencies and how they had to defend themselves. The Turkish lira, which we're probably not going to get to here, but it's very similar to all of these things, the Turkish Central Bank just raised rates to 10% to defend their currencies. Okay, so let me ask one more question. Can the FX Street put up the second question? And then I will... This perhaps is more interesting from a specific point of view. Because you don't have the ability, at least on our system, to trade emerging markets, you could, in fact, take a position in the majors based on what you think is happening here. Because as the Brazilian real, an example only, is fading, what are we going to see? Well, I'll show you. This is what we're going to see. And this is what we saw. This is the Swiss franc. It used to be, and it was, certainly back in 2008, this would have been the dollar against everything else, except going the other way. The dollar would have gotten stronger. But if you can't take a position in one of the emerging market currencies, one of the things you could have taken a position in was the Swiss franc. Now, the interesting thing that we've seen through this from last May on, as far as the emerging markets relating to the developed countries, to the major, okay, this is good then. This is something you can do. I see that 5% of you did, as far as the answers go. That's very, very interesting, because it's definitely true. This is the mirror image, the reverse mirror image, mirrors are reversed, of the real chart that we saw. The thing we have to remember, the thing that's different on this particular event, this particular change in emerging markets, is that we have not seen a great run to the dollar yet. The last time I was on the tube, somebody was asking me about that. And I said, no, this is not a emerging markets crisis, and there isn't going to be any contagion. I said this about a week and a half ago, to the overall world markets. And they said, why? And I said, one, because I think that this is largely a development of money flowing in and out of the currencies in the specific markets based on a search for return. But two, the thing that's telling me that nobody's panicking is because nobody's flooding to the dollar. Now, you have seen this. Let's take a look at the 10-year. That was a great question. Thank you very much thank everyone for responding. I really appreciate that. Okay, here's the 10-year. This is current 10-year. This, you could say, is a flood to the dollar, but I would say it's not. This, to me, is not a panic move. This is the generic 10-year. I will get to those questions next. This is especially because there have been a number of statistics out of the U.S. that have been lousy. Once again, the end of the year, all the equities guys and all the economists say, oh, we're going to have a good year, much better than we think, and many times that doesn't happen. That's what we're seeing here. Everyone was running the predictions from here to here. Interest rates are going higher. I have another chart up here I'm not going to show you that predicts exactly that. Didn't happen. Why didn't it happen? Because we've had 2 months of lousy job growth. Forget about the unemployment rate. We also had, and that's right around here, a very poor, at least as far as projections go, ISM report. We have retail sales, I think, on Thursday. If retail sales are not strong, and they're not, I don't think they're going to be, this is going to continue. So this is not really a flood to the dollar. And that's the other reason I said that there wasn't any, when they asked me why there wasn't any, sorry about that. Let's put up the real. I'm looking for the Bovesa. There it is. Why there isn't any contagion. Remember, I write a lot of journalism myself, so I come by my skepticism honestly as far as what gets out there in the press. Everyone needs a storyline. The stronger the storyline, the better the hook, the better the story. After all, journalists are not only, or even primarily perhaps, informative. They are to get people to read their stuff. I'm not criticizing journalists by any means. I am, to some degree, one myself. But you have to keep that in mind when you're reading the storyline, especially the cause and effect storyline from market movements, which often have very little to do with any particular statistic except in the longest run, and the storyline that you're hearing in the media. So, the events that we are discussing here. Let me see who else we have here. Sorry. Okay, I'm going to run through a number of other items that I want to here because we're getting close to the end here. And one thing that I really want to cover and having a bit. Let me just answer these questions on China here. And I, of course, always thank people. Yes, I forgot, 45 minutes. Okay, would you put up the last question from them, and let me just answer these questions, and then we will. Okay, yes, Andrew Carnegie was actually in steel. He was not in railroads. There are Jay Gould and others. There are many fascinating stories from the 19th century into the late 19th century on speculation in the railroads. In those days, there was no such thing as insider trading, so it was much more like the penny stock market. If you could manipulate the market and get people to buy it, well, then you made money and they lost money, and that was that. China is a very difficult story as far as deciding whether or not there is the degree of danger there. I think from that it's fairly obvious that the Chinese growth of the past 5 years, certainly the past 2 years, has been very much fueled by credit expansion. Chinese banks lend money. They tell and they're pretty much directed to, and the secondary banking system there, which is always called the shadow banking system, much like what's here, highly unregulated, of dubious investment analysis, shall we say. That's an interesting response. I'm not quite sure about that one. I personally think that EM volatility is a benefit for everybody because anything that brings volatility to the markets, although it is a bit risky, of course, means potential profits. There's no profits and there's no ability to make profits without volatility. Anyway, I thank you all for responding for those. We're going to continue to do this through the all of my webinars from now on. I think it's kind of interesting. I kind of like it. So the problem with China is it's very difficult to tell what's going on as far as the extent of the credit problems and you could say the property market questions. I mean, I remember I saw a statistic recently, and I don't have any idea whether this statistic is accurate or not, but that something like 60 or 65% of people in China own their own homes. I'm not sure quite what that means. Does that mean they all have mortgages? I don't really know. And if the market goes bad, does that mean that liquidity is tied up there? And if they have mortgages, then we have another housing problem. So it's difficult to tell. It's certainly true that China can continue, because of its vast resources, to fund this kind of credit-driven development. The problem is eventually it comes to call. And that is the great question, and this is a question which can go on for years. One thing that all of the central banks and governments have done, essentially, is they are trying and have tried through their various tools in the United States, low interest rates, to push the day of decision to the future where hopefully and supposedly economic growth will be strong enough to rescue the problems. So far, that hasn't happened. The question is, has all of this intervention taken down the natural rate of growth in an economy? In the United States, you can only say so far there hasn't been enough growth to return the labor market or many of the other markets to health. There hasn't been that snapback that we see after most recessions. So we don't really know how much the government itself and its interventions have created this. The defenses of this, and this is true in China as well, and in almost every other country. So where that takes us. But anyway, let me go back to the emerging markets and then we will wrap up here. When you judge emerging markets, they do not all respond the same, and they are not all the same. They are all subject to the same macro impact, the same macro policies from the outside. In other words, when the Fed changes policy, it changes it for everyone. So everyone in the world. And they're not intending to. Their primary concern, as with all central banks, is for the individual country that they're responsible to. The Fed's worried about the Fed. Its approach to the rest of the world is, we'll tell you what we're going to do, but it's up to you to take measures to either protect or aid your own country based on what we let you know. The Fed doesn't often, certainly under Bernanke, surprise people. It tries very hard not to. So, some of the differences then are part of the country. They are political and they are economic and structural. Argentina, of course, is the basket case for everyone. It's probably, from an economic point of view, one of the worst run countries in the world. I don't know much about the political history of Argentina and why this is so, but it certainly is so. So the response of a country like Argentina, and traders and currencies, Argentina defaulted not 10 years ago, I think a little more, is going to be very different than, say, a country like Turkey, which has a different and more effective government. Or this is Malaysia, the Malaysian ringgit. So when you look at, I know we're going to have to wrap up here, so I will. When you look at emerging markets, now let's take another one. What's one of my favorites? Indonesian rupiah. From an economic point of view, you see the same chart here that we saw before. But both the potential and the internals stem from a better run country. And this is one judgment that we must be willing to make when we are thinking about these types of currencies and these types of tradings. It makes it more difficult. I mean, one of the things I remember was a big area when I was in grad school was political risk. Political risk based on economics. Because if you're working as a consultant for a company and they want to know what are the risks of FDI here, of foreign direct investment, that's what they're talking about. So, to wrap up here, the possibilities of emerging markets not only relate to the emerging markets themselves, that is, if you want to invest directly into the country, if you want to speculate on their currencies, but there are also mirror investments, as I showed with the Swiss, that you can make depending on your view of what's going on in the emerging markets. Now, an interesting twist on the Swiss. Remember, let's take a look at the Swiss on this. We're going to go, what is the primary driver here? This takes place in the period of the U.S. contemplating and then beginning its taper. When it relates to the dollar, that would seem to indicate a stronger dollar, higher rates. But what do we see here? We see a weakening dollar through this period. That tells me that one of the primary influences on the Swiss franc in this period right here is an influence from the return of emerging markets funds. The judgment being made that because of the competing policies of the central banks in Europe and the United States, it's likely that the dollar is not going to receive, versus the euro, powerful safe haven currency flows. They're going to go other places. One of the places they went to is the Swiss. So from our point of view, as currency traders, this was a trade we could make relating to the emerging markets that wasn't an emerging markets trade. You didn't have to buy or sell the Brazilian real. Okay, folks, I hope this has been useful. It's been very interesting. Emerging markets is not something I usually deal with very much because we don't trade it. But I think we're going to look into opening. I thank you all very much for attending. The Indian rupiah. I think that the rupiah is going to be stable for a while unless we get another downward. In other words, the Indian currency had its blow up along with the real last year. Since then, it's been relatively stable. And unless we get some further developments in U.S. rate policy, I think what you've seen is that the money, the hot money, if you want to call it, that was invested in both the rupiah and the rupee and the Indian stock market is out. So that particular driver is gone. Everybody cut and ran. The people who were there knowing that when things change, they're going to get out immediately. They're gone. And so both the currency and the stock market now starts from a different level. And now you'll have to deal with factors again. So I think that one is done. And I think that's largely true of all of these emerging markets, countries, and currencies that we've looked at. The great run is done. In other words, there was a certain amount of money went into these countries. It's now out, or a good portion of it's out. So now we start over. So that's why I said that I don't view this as an object of dangerous contagion for the rest of the world. Okay, folks, I thank you all very much for attending. I thank FX Street, of course, for putting on and permitting us to put these on. I will put my email address in there. If we have anyone has any questions or comments, please let me know, and I'll be glad to answer them. Again, thank you all for attending. I am, as always, flattered that you take your time to listen to what I have to say. Again, thank you very much, and everyone have a good day.